Government securities is one of the best ways to create a consistent stream of cash flows for the foreseeable future. Did you know that you can buy government bonds for which are expiring after 40 years? Yes, that's a possibility. And this may be the best time to do it because we are in the high interest rate regime, and interest rates, as inflation cools down, will start falling, right? And once interest rates start falling, you will miss the opportunity of buying government bonds and earning the interest income. So in today's video, I'm going to tell you what are government securities, how to deal with them, when should you buy them, and who is it suitable for, and how can you buy them. Okay, so government securities are obviously issued by the government of India, and what they do is they're called GSECs, and what they do is they pay you an interest twice a year. Okay, so how do you identify a government security to begin with, right? So they will be denoted. The first three digits will tell you about the interest rate of the government security. Say for example, if it is 736, it means the government security has an interest rate of 7.36%. Then it will be written GS. GS means government security, and then the year in which it is expiring will be written. Say for example, if it is expiring in 2052, it will be written as 2052. So it will be 736 GS 2052, right? This is how you will identify government security. So now what does 7.36 mean? So if the face value of the government security is say 100 rupees, it will pay out 7.36% as coupon every year. All right. And 2052 is the year of maturity. All these securities are obviously listed in the stock exchange, and you can always sell them, but there is going to be low liquidity for sure, right? So what is the frequency of payment of the interest on the government securities? It's twice a year, which is once every 6 months. So you will get, say if the security has a coupon of 7%, you will get 3.5% twice a year. Okay. So there are two interesting things to denote in a bond, right? Number one is obviously the coupon. Coupon is basically nothing but what interest rate that does the bond pay on the face value of the bond, which we already discussed, right? So if the coupon coupon is 7.36%, it will pay you 7.36% interest on the face value of 100 rupees. All right. Now, what is the yield on the bond, right? So, say for example, if the bond has already been issued, okay, and 3 months have passed, and interest rates are same. So, what's going to happen is that the bond will also have some accrued interest on it, right? So, the effective yield that you will get will be a little bit lower than 77.36%, because the person who is going to sell you the bond will sell it to you at 103 rupees. For example, if the bond has a coupon rate of 7% and you bought it at 100 rupees, and after 3 months you want to sell the bond to someone else, right? So in 3 months, how much interest you would have accumulated on the bond, right? So if 7 rupees is the annual interest, then quarterly interest is 1.75 rupees, right? So if you were to sell the bond, you will sell it at 101.75 rupees, because this bond will basically be priced higher, because it will also include the interest that has been accumulated over 3 months. Now let us take an assumption that new bonds that are being issued after 3 months is being issued at 6%, right? So if you were to buy it from the primary market, which is the government of India, you can always buy it at 6% and at 100 rupees face value, right? But if you were to buy it from someone else who has a 7% coupon bond, he will not sell it to you at 100 rupees. He will sell it to you at a price on which your yield is 6%. So let's take for example, if he is earning 7 rupees on his 100 rupees bond, and the new bonds are earning 6 rupees on a 100 rupees bond, then for you to earn 6 rupees on a bond which actually has a coupon rate of 7%, how much, at what price should you be buying that bond? So the calculations are not so simple, right? I'm just giving you a very simple example wherein the coupon rate of new bonds has changed from 7% to 6%. So when you bought the 7% bond at 100 rupees, and if you were to sell it, you will be selling it at 116 rupees, so that to the new buyer it yields 6% only, right? So what you have to do is 100 multiplied by 7 into 6. This is a very simple calculation. SEBI has a link wherein you can do the complex YTM calculations. I'm adding that link in the description box below for you to check. Now let us move on and understand the other aspects of the bond market, of the government securities market. So we have understood, the relationship between interest rate and the prices of the bond, right? If interest rates go down, the price of your bond will go up, and if interest rates go up, then the price of your bond will obviously come down. Okay, so now how do you buy the government bonds? The simplest way to buy this is through the primary market. There are issues every week that come up, and Zerodha has a feature through its coin platform wherein you can buy the bonds. So I have started buying this bond in my mother's account for a simple reason that this will yield me high interest rates for the next 30-40 years, right? So what you need to do is go to Zerodha and go to the coin platform, and then when there will be a filter on the left side, top left side of the screen, and once you filter, you will see government securities. Once you do that, you will see all types of securities that are being issued. So you will see three types of securities there. One will be GOI dated bonds, which the bonds that we are talking about. You will see multiple tenures, 10 years, 30 years, and 40 years. Then there are T-bills. These are short-term tenure bonds, which basically is not the part of the discussion of the video. And then you will also see state development loans. These bonds are issued by the different states in the country, right? So primary market purchase is important so that you can buy large volumes at decent yields. Because what happens in the secondary market? What is secondary market first? Let us first understand what is secondary market and primary market. Primary market is when you buy it directly from the issuer, right? And secondary market is basically when you are buying from a person who already owns it. So in the secondary market, you will see that there is a very big challenge of liquidity. There is not much liquidity, unlike the stock market, wherein you can buy it at a fair price, right? And there are large players who want to sell, so your pocket may not allow it, because when you buy it from the primary market, you can always buy it by as low as 10,000 rupees to start with. All right. So what I prefer is I prefer buying from the primary market. So now, how does taxation work? The taxation is very simple. You need to do is all you need to do is you need to the interest that you earn on the government bonds is taxable at your slab rate. So that's why buy it when you are buying it on your parents' account. What happens is, when you transfer money from your own account, example, to your parents, it is considered as a gift, and taxation is considered as a part of their income taxes only. Clubbing of income tax rules does not apply. So that is one more advantage. And then another advantage, if you plan to sell this, then short-term capital gains and long-term capital gains tax will apply. And short-term capital gains will be, if it is held for less than 12 months, it will be taxed at slab rate, and if it is held for more than 12 months, long-term capital gains tax will apply, and it will be taxed at 10% without indexation. Okay, so if you plan to buy it, I'm sharing the and do not have a Zerodha account, I'm sharing the referral link of my Zerodha account. You should definitely open one and start buying the securities, especially when you want to create a consistent income. Taxation is something that you need to consider. If you are in 30% tax bracket and above, this may not make sense, but in the longer term, it may start making sense when India is in 3-4% interest rate regime and you have a 7% bond. Even if you are paying 30% tax on it, your post-tax returns will be 5%, which will be higher than the interest rates going on, which is what the trajectory looks like. Other way to do it is to do it, if your parents have some money, or if you can give them some money, you can buy it in your parents' account for them to have a consistent income. Yeah, so I hope this makes sense, and if you have any questions, feel free to ask me here, and do not forget to like, share, and subscribe. Let's look forward to the next video.